So, say you can't afford to buy a house in one of the big major cities. You can still play in real estate by investing in real estate stocks. We're off to the TSX Broadcast Center for further perspective on that from Greg Bunnell. Greg?
An entire generation feels like they're being priced out of the hot markets, but you don't have to only buy property. You're here with Andrew Moffs of Vision Capital. He's the Senior Vice President. You say that you can actually play real estate more effectively through the public markets.
Absolutely. We look at the private market values, and then we aim to go in the public markets and see where we can buy stocks at a discount to those net asset values, or we go short the ones that are trading at a premium.
So does that make sense for someone, perhaps a young person, that instead of saving up the down payment to buy a house that could be maybe at the top of the cycle, maybe if they want to take part in that, and they feel like they're going to miss it altogether, but you can still take part in that appreciation through a REIT?
Absolutely. I mean, in using that residential theme, one of the things we love today are the public apartment REITs. Residential, if you think of some of the demographic changes that have gone on, the secular changes, today the millennial generation, there's a trend to urbanization. People want to walk to work, they want to walk to Starbucks, they don't necessarily want to buy a home, and you can see affordability is pricing people out of homes. That's really great for the apartment REITs. If you look at Canadian Apartment REIT, that's the largest landlord across Canada, 50% of their portfolio in the GTA. That's trading at a massive discount to net asset value, yet it benefits from people wanting to rent instead of own.
I wanted to ask you about that idea of the rental renaissance. We really latched on to that term in the media just because it sounds so good. Are you actually seeing that happen now? Because we know there hasn't been a lot of purpose-built rental in this country in the past 2 decades. Are the REITs, some of the developers, starting to get a win to that and getting some shovels in the ground?
Oh, exactly. One of the biggest trends today is mixed use. And you're seeing traditional REITs like RioCan, a retail landlord, trying to look at their sites. Where can we go vertical and do multifamily? That just bodes well for the incumbent REITs that have been doing this for years. And so, yeah, no, it's a real trend that we see in the market.
And now when it comes to investing through the public markets in real estate, obviously you don't have to stay in the geography of Canada. How do you see the Canadian real estate market in terms of investing that way compared to the rest of the world?
Well, it's interesting. You have to go sector by sector, market by market. Again, we like apartments. They can be both, you can get growth there, and we see that, but they're very defensive, both in Canada and the United States, meaning even in the depths of the financial crisis, you were able to get financing from Freddie and Fannie in the US, and here's CMHC. But then if you start looking at the office sector, you think, wow, there's big secular changes globally. If you think 20 years ago we built office space 250 square feet per worker. Today it's 150 square feet per worker. Law firms don't need a law library. So you have these big secular changes going on at the same time. You look around, there's cranes in the sky. You see 5 million square feet coming on in Toronto, similar amount out west, and at pretty much the wrong time in the economy. So we're actually short office for that reason.
I wanted to talk about that because obviously what we talk about residential properties, we know Calgary's been hurting, but also on the office space side, we know that vacancies are rising. Does that mean that investors have to be very careful about the REIT that they're playing and how much Calgary exposure they have right now?
Without a doubt. You look at a company like Dream Office REIT, they own office space across Canada. As I mentioned, they are hurting from that secular change in demand that's going on, but at the same time, all the supply. 20% of their portfolio in Calgary. It's a very tough market. Today we're seeing net effective rents. That's taking gross rents, the asking rent, but then deducting the free rent that you get as a tenant and some of the incentives landlords give you. We're seeing net effective rents of 0, meaning landlords are basically saying to their tenants, please just come in here, cover our operating costs. And that's really going to be tough for landlords like a Dream Office REIT or an Artis REIT that have a big exposure in Calgary and Edmonton.
Now, those are some names perhaps that you want to take a careful look at before you invest. Are there some names in the Canadian REIT space that you liked and you think are investable?
Oh, absolutely. I mentioned Cap REIT, Canadian Apartment REIT. InterRent REIT is another great residential REIT that is doing a lot of great value add stuff where they buy properties, upgrade them. I mean, you look at some of their investments from 2012, they increased the NOI 50%, the value is almost 90%, simply by buying properties that were unloved and bringing them up to market and increasing the rents. Maybe on the senior living side, we really like Chartwell retirement residences. That's a great demographic change of seniors moving into assisted living facilities and retirement residences. Again, here's an asset class that previously the public markets didn't appreciate, had such a great valuation, but we see it in the private market. And so if you actually put those cap rates that you're getting in the private market onto a company like Chartwell, you see it's trading at least a 20% discount to net asset value.
Well, thanks for your time and your insight today, Andrew.
Thank you.
Here with Andrew Moffs of Vision Capital. Michael, back to you in the newsroom.
All right, thank you.